so we're going to get started. We're talking about credit, and we're going to talk about the components of credit, a sample format of a credit report. I thought this would be really good for realtors who haven't seen the kind of credit report that a mortgage company uses. You hear about them all the time, and you may even have a consumer credit report that you get occasionally, but it's good to see the real credit report, the mortgage credit report, and get a chance to look at all the components of it. Next, we'll look at the derogatory aspects of credit. A lot of people focus on the derogatory aspects, and we're not actually going to spend more than about a third of our time talking about the derogatory aspects because so much of the other parts of this are important today. And then finally, we're going to look at some solutions to any problems that people have with credit, ways that they can fix their credit or just improve their score and things like that. So that's what we're going to look at today. Let's go ahead and start with the components of credit. First of all, when we're looking at the components of credit, the most important details of the credit report are the identifying information of the credit account. Here we're looking at who is the lender, and we're looking at the type of credit that somebody is going to get and the account number. The second thing that we're looking at would be the current status of payments to creditors. I think this is pretty obvious. This is the one people focus on a lot. And we'll talk a little bit later about how important the current status of the payments would be. We're going to look at the history of a person's payments to creditors, the balances on loans. People don't realize how important it is when you look at the balance on the loan as a percentage of the total limit. We'll look at the credit limits on lines of credit and term loans, the general terms of credit, and the source of information. Now, when we talk about each of these items, excuse me, we're going to look at, excuse me again, excuse me, okay, we're going to look at how this affects mortgage in particular, although every once in a while I'll bring up an example from auto or consumer credit as well. With the identifying information of the credit account, we're looking at the lender's name because we want to make sure that the credit line that you see is actually the borrower's credit line. You'd be surprised how often, even when we're not talking about a junior and a senior with the same name, you'd be surprised how often we end up with the wrong person's credit on a credit report. The type of credit is very important because one of the aspects of how credit scoring is done is based on the type of credit. But then on top of that, clearly it's important to somebody who's doing an auto loan whether you've paid auto loans back on time. A mortgage lender is going to look to see if you've paid back mortgages on time. You'd be surprised how often people think that having a foreclosure isn't all that important. But if you're the guy making the loan, think of it if it's your own money. Are you really going to be inclined to give a loan to somebody who has a history of not paying you back? And then finally, the account number is very important because sometimes people have more than one account with the same creditor. Let's go ahead and take a look at a sample format of a credit report so you can see these things together. What I've done is I've highlighted in that sort of off orange color, that kind of beigeish color, each thing that we're going to talk about as we go through screen by screen. So as we go through, do us a favor and don't ask questions about the other stuff yet because we're going to get through every part of this sample format of a credit report. And so try to limit the questions to those that we cover page by page. So here we're starting with the sample credit report. I'm going to show you how we're going to do it. What I've done is I've highlighted the boxes, and the credit reports today come with two lines. I hope they can see. Do you think they can see my arrow? Okay, so what I'm showing you here is this line where my arrow is right now goes with the top line of each credit line. And so there you'll see also that if we go to the bottom line on the next screen, I've made it so you can see that. So the second half of the header here goes with the bottom half of the credit line, line by line. So you can see on the next one, you've got the things that go with the top line here, and then the things that go with the bottom line here. So that's our legend, so to speak, so that we know how these things work. And now we'll go through and look at each one individually. Let's start over there on the left. And in this, you're going to see that it shows the Equal Credit Opportunity Act. That's what ECOA stands for. That's the farthest to the left. And it shows whether also it's a single account held by a borrower, the co-borrower, or a joint account, or even as just an authorized user. So you've got ECOA on the left, and then whose account second from the left. The next part would be the creditor. Seems pretty obvious. This is the lender information, and it's used to identify the creditor from a different one or multiple accounts with the same creditor. The creditor box, then, if you look down below, it's for this section here, and because it covers two lines, it covers two lines for each of the credit lines. So you can see the top line is always going to be the name of the creditor, and then the second line should be the account number for that creditor. So this way, if you have two American Express accounts, you'll have two different account numbers. The next the next category that you see is the date reported. Some creditors report slowly, or worse, some creditors even stop reporting altogether once they get paid off. And the age of the credit line matters to a new creditor. So basically what we're looking at here is, when was this specific line of credit most recently reported? You'll find in any given month that it'll be the current month, last month, sometimes it's even the month before, because it depends on how quickly or slowly a creditor actually reports to the credit bureaus. What's important about this is that people often think that their current loan payoff is what they see as of the date reported, and that's not necessarily true. So you always have to look to see when that date is in comparison to today's date, and then go from there. The problem with companies that close out an account and stop reporting is that you then don't have it continuing to age properly after that. I've even seen situations where a creditor will not report the final thing that happens on the line of credit. So if you have a payoff, they show the most recent balance and not the one after that when it was fully paid off. That's a bad thing. So what you'd want to do in a case like that is get the credit bureaus to update it one more month. You can see that we've skipped over a few things, and that's on purpose. We're going to go back to them. We're next looking at the balance, the past due, and the status. Those go all together. Those are the current status of payments to creditors, and so we'll do one at a time. The balance is the current balance, and it's compared to the credit limit when a lender is looking at the balance. You want to know what the most recent balance is. What's important to note here is it's not the balance that you think you have as of that day. It's actually the balance as of the date reported. So we go back to the date reported over here. In this example, it's the balance that was reported on September 12th, not necessarily the balance as of April 25th, 2013. The other thing to note is that people who pay off their credit card in full every month have to understand that every bit of information that you see here is coming directly from the creditor, and they close the monthly billing and send that to the credit bureaus. So if you have a balance with a minimum payment and it arrives at your mailbox, that's what's going to show up on the credit report. Then that very next day, you send them a check and pay it off in full. That never shows up to the credit bureaus. There's no way for the credit bureaus to know that you've paid it in full, because then you start charging again, and by the time the cycle ends, you've got a new balance that gets reported to the credit bureaus. So it's better to know how to time that, and we'll cover that in a minute, but it is important to know that it's never going to reflect the moment that you see unless the creditor has somehow reported the moment before you saw it. And we know the likelihood of that. Okay, next, let's see what we have here. Also about the balance, if it's a term loan, it starts at or near the limit, and that's okay. If the balance is higher than the limit, that could be a problem, because that means that something's occurred that caused you to exceed their original limit. When it's revolving, the percent of the limit is very, very important. So you want to compare the balance to the credit limit. Next one is the past due. Oh, we've got a question. Let's see. I'd like to know when the credit agencies report the balances. That's a very good question. The question was, when do the credit agencies report the balances? And it's actually the other way around. The question really should be, when does my credit card issuer or my car loan company or the servicer of my mortgage report to the credit bureaus? The credit bureaus don't report, they receive. And all the creditors actually do the reporting. And the answer is they report whenever they feel like it. Some do it on the 20th, some do it on the 23rd, some do it on the 1st. The only way to know is to look to see when the cutoff is for your balance, and that's on your statement every month. Look to see when they cut it off, and then within a few days it's usually sent electronically to the credit bureaus, and that's how they aggregate it. All right, we're going to next look at the past due. The past due heading is, if there is an amount in there, then that means that the loan or credit is currently past due. It will never show an amount in there for prior past due once it's been caught up. So that's one of the worst things you can ever see on a credit report, is a dollar figure in the past due column. Next we look at the status. The status will indicate whether the account is or was paid as agreed. And that's is or was past due, or was settled, or in some way not paid as agreed in the terms of the initial credit facility. So when you're looking at the status, it's going to tell you all kinds of good information about that. The important thing about the status is that any time that somebody negotiates any kind of a settlement, then it should be listed as not paid as agreed, because you had an agreement initially, and that's that is the source of where they're going to compare to see if it was paid as agreed or not. It's not about whether you have come to a new agreement and agreed to pay less. When they accept any payment that's less than the full amount, then you are not paid as agreed. All right, let's see what question we have. Why do you sometimes see recent reported dates for an account that has been paid off or closed for some time? That's an excellent question. The reason that they show the reported dates is because they want to report every month into history. You never want them to stop reporting, because if they do, then it becomes stale. The credit reports go back 7 to 10 years, and we'll discuss why in a moment, which one of those numbers. But because of that, you always have to have the current reporting even of paid off accounts until they drop off completely by law. Now we're going back to the date opened and date of last activity, as well as the months reviewed and numbers of days late. Starting with the one on the left, you can see this is a double row in this column. The top portion is the date that the credit facility was opened. This shows whether the account is the borrower's, the length of time established, and how to improve the credit. And so it's very important that you know when the date was that it was opened. I'll give you an example. In this top line, you can see it was opened in April of 2011, and then if you come all the way over, we're going to talk about months reviewed. That's 14 months reviewed. This shows how long they've had that account, because age is significant to a creditor. Again, going back to whether you would lend somebody some money, if you know that they have a history of paying people back for 20 years, you have a much stronger feeling for that borrower than you would if you found out that they opened 3 accounts 6 months ago just so that they could get a mortgage, and they've paid them on time for all 6 months. Whoopee! That's really not a whole long time. All right, the date of last activity is important because it doesn't say what type of activity. Is it a recent payment? Did they increase their borrowing amount? Did they pay some toward the balance? So it's very important to know the DLA, or date of last activity, to see whether this is a recent account or it's a stale account. What's also important is that whenever you have a collection account, any kind of a charge-off, any kind of derogatory like that, then getting back to that creditor and starting to make payments will bring that last activity current again, and that can actually lower a credit score because you have made new activity on an account. Then we go over to the months reviewed and the number of days late. That's on the right-hand side here. The months reviewed shows the age of the payment history. Most mortgage lenders want at least 12 months for each line of credit. And furthermore, when you look to the right of that, you've got your 30, 60, and 90 plus. So these are going to show how many times you've had over 30 days late, over 60 days late, and then over 90 days late. The important thing here is when you have a rolling late that goes 30 days late, and then you pay a payment over 30 days late, but every month after that, you keep making only one payment. That rolling late means that you're always 30 days late, you're always 1 month behind, and it'll keep on stacking up. 1 month, 2 months, 3 months, 12 months, 24 months. So you have to, at some point, double up the payment so that you catch back up and get under 30 days late. Now let's talk real quickly about mortgages when it comes to 30 days late, because a lot of people don't realize that when a mortgage is due on a 1st, it's late on the 2nd. Everybody points to the ability to pay all the way through the 15th without having any kind of a late charge as being the time that that payment is due. In fact, it's not. It's due on the 1st, late on the 2nd, you have a grace period through the 15th, and then you start having the late charges on the 16th. The beauty of all this and the credit scores, credit bureaus and everything, is that you're not charged over 30 days late. It doesn't get reported to the credit bureau as over 30 days late until you really do pass 30 days late. So for example, in the month of May, your payment will be due on the 1st, and if you haven't made the payment until the 30th, you're not over 30 days late and you're still on time. You have to pay the late charge, but you're not reported to the bureaus. On the other hand, if they receive the payment on the 31st, then you're 30 days late. Furthermore, if it goes to 60 days late, you can catch that up and you'd only have one, so it's not going to automatically roll. All right, so now go back to the 30, 60, 90. The lenders are going to look at your willingness to repay. And that's the important thing about mortgages today, is they're looking at two parts of this. A lot of people think that they only look at the ability or they only look at the willingness, but they're looking at both. And of course, as a fallback, they've got the collateral of the property as security. But when we're looking at the credit report, we're only looking at willingness to repay, not ability to repay. You'll notice on here, there's nothing that talks about income. There's nothing that talks about assets. The way this works is the lenders assume that a creditor is going to give you a credit limit that you can afford. And so therefore, if you have a high credit limit, you must be able to afford it. If you're borrowing a large amount against a large credit limit, then that just simply means that they know that you can afford a large balance. When a creditor is looking at the other parts of the 30, 60, 90 and the months to review, then they're going to look at how many of each kind of late that you might have had, as well as how far back it goes. When we're talking about credit, we're talking about breadth and depth. And so breadth is how many different accounts do we have. Depth is how long do we have those accounts. And so that month's reviewed becomes very important to a lender, especially with programs that require that you have at least 3 active trade lines that have at least 12 months of history. So in this example, if this borrower had only these lines of credit, then you can see in that months reviewed column that they have 14, 7, and 56. So they don't actually have enough breadth of credit to get a loan, to get a mortgage with anybody who requires 3 trade lines of at least 12 months. The next one we're looking at is below balance. That's the terms of the debt. The terms of the debt show, if it's an installment, the number of months and the dollar amount that was borrowed, or I'm sorry, it was is currently being paid on it. Let me do that again. In the terms, it's going to show the number of months and the amount of the monthly payment. And then on revolving credit, you'll see the amount of the minimum payment only. So we have 2 examples of that right here on this example credit report. This sample shows a mortgage that has a 30-year with $1,235 as the minimum payment. Understand that if it includes taxes and insurance and an escrow account, this will be the total payment with escrows. This is the real honest-to-goodness payment that has to be made. And then further down, you'll see 2 revolving accounts that show the balance and the minimum payment. Next, we're going to look at something that doesn't actually have a box in the top legend. This part would be the unboxed descriptions, and they can have additional information about the type of credit, the identity of the creditor, the current status of the loan, the dates of any late payments that might have been received, and even who closed the account. So let's go ahead and look at some of those and why they're important. The type of credit is important because today with mortgages, you have to know whether somebody already has an FHA loan or not. If they can only have one FHA loan, then knowing that their current loan is conventional is really helpful. Another thing it might say is whether it's a Fannie Mae or a Freddie Mac loan. Under identity, it may tell you that this person is an authorized user, like in our third example on the bottom. That's important to know because they're not the actual borrower and they're not responsible for payments, so most lenders will not use authorized user accounts as even a line of credit at all. Sometimes you'll have current status or the dates of late payments. That's real important because a lender needs to know not only that you had 2 30-day lates, but they need to know when were those 30-day lates. And so under this section here, you'll actually have a list of the most recent 30, 60, 90, and plus day late months so you can see how recent they were. So how much do you think the payment history counts in your credit score? I know you can't answer. That's the only problem with a webinar. But I'll go ahead and show you anyway. You know, I always thought before I got into this business that the payment history was 75% or something really large as a percentage of the credit score. But it turns out that the payment history, as you can see in the blue section of this pie chart, is only about 35% of the credit score. The next biggest is 30% for the amounts owed. The amounts owed is when we're talking about how much do you owe as a percentage of the limit. So you may recall back earlier in this webinar I mentioned that when you have a term loan, like a car payment or any kind of installment loan like that, you're usually going to have your limit to be whatever you took out in the beginning. Nobody cares that you have a high loan balance as of the credit limit on a term loan because everybody expects you're going to start high and pay it down as you go. But on revolving credit, it's very important to know whether you are maxed out on the credit card or not. So if you have a credit card that has 90% of the limit borrowed or higher, then you could lose as much as 100 points off the credit score. Going down from there, some lenders say that if you have at least 50% paid off, if you've only borrowed 50% of the limit, then you're going to have a good credit score. That's not necessarily true. What that means is that you're going to have a better score than somebody who has 90% of their limit borrowed. At 50%, you'll have a better credit score than somebody who has 70%. But actually, it's not a hard and fast number that when you're below 50, you suddenly have the best credit score you can get, because they actually grade it from over 100% all the way down to 10% of the limit. We have a question: can an authorized user be affected negatively? Unfortunately, yes. An authorized user can be affected negatively. You just don't get credit for it. So it's one of those bad situations where it can't help, it can only hurt. The nice thing about being an authorized user is you can charge on somebody else's credit card. So that's not all bad.
Let's go shopping.
Yeah, let's go shopping. All right, next in green, you'll see the length of credit history. You may recall earlier I was talking about how important it is that a lender see that you've established your credit history over a long length of time. So the longer that you have the credit history of paying on time, the better it's going to be. The importance of this is if you have old established accounts, it's not a good idea to close them. It's a good idea to periodically make sure that you use those old accounts. Even if it's an old department store, if the department store is still in business, then it's worth it to go there every 6 months or a year and go charge a pair of socks or get something you were going to get anyway, and then pay it back off again and keep that account active. Because length of history, 15% is a big number. The next pie chart is the new credit. It covers 10% of the credit score, and the reason for that is because people who have new credit oftentimes are getting into some kind of trouble. They're trying to get new credit because they don't have enough cash to pay for things. This isn't always true. That's why it's only 10% of the credit score, but it's an important aspect of the credit score. And finally, the types of credit used is 10%. You may wonder, what in the world would types of credit used be? And what I've learned is that you can think of credit scoring as scorecards. And what I understand is you may have 8 or 10 different scorecards. And by the way, the reason I don't know more about this isn't because I haven't tried to learn. It's because FICO keeps this as very, very closely guarded secrets. Think of them as trade secrets. And so they don't let everybody know what goes into how they do things. But the types of credit used would be, for example, a mortgage would be one type. A car loan would be another type. A revolving credit card would be another type. A home equity loan would be another type. All these different types tell the new creditor that's looking at your credit score whether you would be a good credit risk. And so if all you've ever had is 3 credit cards and you've never had a mortgage and you've never had a car loan, so you've never had a really important installment loan in your life, then you should have a lower credit score than somebody who has had a real good mix of different kinds of credit and paid all of them perfectly on time. I will say that when you have a 30-day late on a credit card, that's not going to be looked at as negatively as a 30-day late on a mortgage. But still, they're both 30-day lates and they're both important. So the advice on types of credit is, sure, it's good to get credit cards and have your 3 lines of credit with at least 12 months each, but it's better if you can have an installment loan, and it's best if you can have all of the different kinds. When we talk about derogatory aspects of credit and we talk about the payment history, well, it looks like I covered some of this already. So we talked about willingness to repay, the length of time that the credit exists, and the breadth of credit being the number of different accounts that you have. The other thing we need to talk about is the number of lates, the 30, 60, and 90-day lates. When I first got in the business 20 years ago, we didn't really use automated underwriting yet. We had credit scoring, but people didn't really understand it very well. And so underwriters would look to see how many lates you had. And fortunately, we've gone away from that, because when underwriters were using that kind of personal opinion and subjective analysis, you'd have somebody say, well, he had a 30-day late on a credit card in the last year, so we're going to decline the loan. Nowadays, almost nobody gets declined for a loan with a single 30-day late on a credit card, even if it is within the last 12 months. On the other hand, if you have a series of 30s, or you have a mixture of 30s and 60s and maybe a 90 here and there, the more that you have, the more it's going to bring down the credit score, even if you have a multitude of accounts that have been paid on time. What I will say, though, is the more breadth you have of credit, in other words, the larger number of lines of credit that you have, the less it will impact you if you have a smattering of lates here and there. So what I'm trying to say is that if you have 3 accounts and you have 2 30-day lates, that's going to be a whole lot worse than if you have 13 lines of credit, open accounts, and those same 2 30-day lates. So the breadth really makes a big difference. The recency is something we haven't talked about. The recency of the credit of the lates is vitally important. Credit scores actually are designed to try to predict whether somebody's going to be over 90 days late within the ensuing 2 years after they give the credit. So most everything is geared toward the most recent 2 years. Things happen, life changes, people run into hiccups and things, and creditors understand that. But at the same time, you can probably think of somebody you've known who has been extremely, extremely detailed about things in their life, and they would never let anything go over 30 days late to save their lives. And then you've got the other kind of people, and actually it's kind of funny because I have young adult children, and I've got both kinds. I've got the kinds that pay everything perfectly, and I've got the kinds that kind of miss things every once in a while. And so when you've got somebody who misses things every once in a while, that points to their willingness to be steadfast in making sure the payments get paid on time. And it's important to note that it's not a character flaw. It's just the fact that some people don't put as high an importance on it as they maybe should. So the lender is going to look at that, and excuses don't really hold a whole lot of water unless it's a very serious excuse that can be proven. For example, if you're going to say that I had a serious medical condition and I couldn't pay my bills for 3 months, then the lender wants to see that, A, you really had a medical condition. So show the lender the proof that you were in the hospital. You don't have to show them the scar, but you want to show them proof that you were in the hospital with a medical bill. And then the second thing would be, they want to know that you caught it back up and you've been perfect since. So don't expect the lender to give you that new mortgage with 3% down when you still haven't caught up those late payments. But on the other hand, if you had a perfect payment history for all the years you've been alive, then you had the gallbladder removal, and then you went back to paying things on time again, then that's going to show up in an improving credit score, and it will also give the lender some confidence that it really was a one-time event. I can tell you, I see people all the time who have low credit scores who have an excuse every year about why they paid things late. There's always an excuse. And those are people who really just haven't shown a willingness to repay. They haven't made sure that they have enough savings that in the event of an emergency they can make sure that things are still being paid on time. Before I go to the questions, I'm going to finish up this slide talking about the collections, charge-offs, and settlements. Any type of full default on paying somebody what they were due is going to be called a charge-off. What happens there is the creditor is saying, I no longer believe that you'll ever pay me, so I've written it off, and it's now considered uncollectible. So they've taken it off their income. Whatever business it is no longer considers that to be a sale or income, and they no longer expect to collect it. A charge-off can only be any kind of credit can only be collected by law for 4 years unless somebody just voluntarily pays it. But they can then send it to a collection agent, which would be an attorney or just a company that does collections. The difference between a charge-off and a collection is that a charge-off doesn't necessarily expect to ever get repaid. A collection is where somebody is now trying to collect that delinquent or unpaid bill, and they're the ones who get paid, not the company that had the charge-off. So if a bank has a repossession of a car and charges off the remainder of that balance and then sends it to a collection agent, you wouldn't go back to that original automobile creditor to try to settle up the account. You'd actually go to the collection agent and negotiate with a collection agent instead. When you get settlements, any type of settlement, whether it's a short pay on a mortgage, or it's turning in a car and coming to an agreement that you're even, or coming to a settlement agreement with a collection agent where you pay 50 cents on the dollar, all of those are not paid as agreed. And the only thing that's going to make those look better is time, because time heals. But otherwise, it's still considered a default even if you settle. Now let's take a look at a couple of questions. Question 1, if you have a derogatory mark on a credit report, is it best to dispute it or ask the creditor to remove it if it is in fact an item in dispute? Well, I can't tell you what to do if it's truly disputed. I can tell you that anytime you have any derogatory on your credit report, then disputing it at first can help you, and it's a good idea to go ahead and dispute it before you try to get a mortgage. The only problem today is that lenders can't allow a dispute to stay on the credit report, because the funny thing about disputed accounts is that FICO scores don't factor the disputed account at all. So in other words, you could have a 700 credit score because the disputed account doesn't show up in the FICO score, and then as soon as both parties agree that you really do owe the money and the dispute is lifted, then the credit score will plummet, because then the credit score really will be a reflection of the current credit environment. So the best way to think of it is dispute it, get it resolved, and then get that dispute back off the credit report before anybody applies for new credit. I don't think car lenders really care about it as much as mortgage lenders do, but Fannie Mae and Freddie Mac actually have it written in the automated underwriting findings that there's a disputed account and it must be resolved prior to getting approval.
I've actually had that identity theft happen to me, and I've had to carry written letters from certain places saying this was not me, and provide that to for mortgages for like the last 6-7 years.
Yeah, and if you know somebody who's thinking about getting any kind of credit and they've had any kind of situation like Annette's, make sure that they report it to the police, because it's vitally important to have a police report to be able to put with the dispute if it truly was any kind of theft of identity like that.
And it did take a while for them to remove it, and I had to be persistent, but they finally had it removed. But I keep those letters. I don't get rid of them because it's the only thing I have that proves that it really wasn't me doing this. So.
And we'll talk a little bit more about disputing in just a moment. Let me go ahead and move to the next question so we can get through all of our slides. Do you ever get a chance to state your case to a creditor, or is it all a paper process? If you mean state it verbally, I don't know any way that you can do that except when it's a small creditor, but the truth is that I have on occasion called even the IRS and said, okay, here's my situation. I think that you should give me a second chance. And sure enough, they did. So I think absolutely the first place you want to dispute anything is with the actual creditor itself and see if you can work something out or if you can find out if it's really true. And then the second thing would be to dispute it directly with the credit bureaus and provide proof. I will say this, when you dispute, if you have a real honest-to-goodness reason and you can prove it in writing, then dispute it, state it, and provide the written proof. On the other hand, if you are one of those people who have just an old thing that you really wish wasn't there and you want to dispute it to see if you can get rid of it, I encourage you to try. But in that case, what you want to do is simply say, reported in error. That thing was reported in error. You don't need to give it an excuse. You don't need to say why, because the law is that if you dispute anything, the creditor has 30 days to prove or remove that that actually exists. The only bad thing is that they may remove it and then find out later that it really did exist, and then they're allowed to put it back on. All right, let's go back to another question. Collections, charge-offs, settlements, is it better to not pay or just rely on time to heal the wound? Well, it depends on how recent it is. If it's recent and you know you really owe it, then it's best to go ahead and pay it and get it done with, because then at least it'll be a paid collection account. A paid collection account ages better than an open collection account, because an open collection account means that you still haven't paid. On the other hand, when it gets to be 4 or 5 years old, then it's at a point where it's better to leave it alone, especially when it's a charge-off. There's nothing you do about a settlement, of course, because a settlement really is already settled. There's nothing more to do about that. Second question is, what about identity theft that is being prosecuted? No. Yeah, that is prosecuted. With regard to the charge-off and settlement, how does this show up, and how do we correct once it goes to collection? I really don't have an answer for that, because if you're in the middle of actually prosecuting it, then I don't know that you're really going to get very far with the with settling it or anything else. I mean, it doesn't make sense to me that you would have any kind of a settlement with something that's being prosecuted. Sally, if you can ask that question a little bit differently in a moment and make sure that I'm understanding it correctly. The best thing to do is, if you're prosecuting anything, is make sure that you have the adjudicated result and dispute with that. That's going to be a judgment, and you can show it to a creditor. All right, let's go to the next page. Let's see. Okay, when we talk about payment history, we're all in this about real estate today, not about our own personal situations. So when we're talking about mortgages, mortgage lenders generally look for mortgage lates in the last 24 months, unless there's a long history of late payments. And they're never going to do a loan. I shouldn't say never. I'm not ever going to say never again. I'll never say never again.
Okay.
But in most cases, you can have one 30-day late in the last 12 months and two 30-day lates in the last 24 months, as long as they are not both 30-day lates in the most recent 12 months. Or you can have one 60-day late in the last 24 months. If you have more than that, generally, the lender is going to decline the loan. Now remember, when I say generally, I'm not talking about portfolio loans. I'm talking about FHA, VA, Fannie Mae, Freddie Mac, the 96 or whatever % of all loans that are being done in America today. Any portfolio loan can follow their own rules. You can do hard money loans that don't have any rules, but this is when we're talking about the general agency types of guidelines. Next, we'll talk about foreclosure, bankruptcy, and true financial judgments. A foreclosure is the worst thing that you can have, but it doesn't stay with you forever like a judgment might. So with a foreclosure, the lender for a Fannie Mae or Freddie Mac loan is probably going to look for 7 full years since the foreclosure happened. And if that sounds harsh, remember, they took out a loan and they didn't pay it back. So I'm not going to line up to give them another loan. When we talk about bankruptcy, that can be shorter because there are 2 types of bankruptcy. Chapter 13 is a bankruptcy that you pay back. And so you generally, if you're paying 100% back, lenders are going to look at that a lot more favorably than if you're doing a Chapter 13 where you're only paying 50 cents on the dollar or something like that. If you have a Chapter 7, a complete discharge of the debt, then you have to wait longer than you would have if you did, in fact, pay some or all of it back in a Chapter 13. So a Chapter 7 bankruptcy, you have to wait longer than a Chapter 13 bankruptcy. And by the way, don't ask me how long for each because every program is different and sometimes even the lenders are different. So that's the kind of thing you'll have to ask when you have a specific case. Go to your favorite lender, whoever that might be. Next, the financial judgments. A judgment stays on your credit for 10 years, as do bankruptcy and foreclosure. So the problem with those kinds of things is that it's not going to go away with just 7 years like you do with regular credit. The other bad thing about a judgment is it can be renewed by the person who has the judgment. So at the end of 10 years, if they renew it, it's on for another 10 years. So it is best to try to resolve a judgment. The reason a judgment is important is because many lenders think that a judgment can impact the lien, and so they want all judgments to be cleared unless they're on a payment plan that has payment history. All right, the other part of the derogatory aspects of credit, I'm going to go quicker over this part because of time and just say that we talked briefly earlier about the amounts owed. The percentage of the credit limit and being over the limit are what are important for revolving credit. The percentage of the credit limit shows whether somebody is truly running out of cash. That's why they use that so importantly compared to other things. It's 30% of the credit score because what you find with people who are in financial trouble is they start borrowing on a bunch of different credit cards. They borrow on one to pay another minimum payment. They open new credit accounts and max them out. And so when people are maxed out on credit, then it does show very, very high rate of now I forgot the word, but there's a real good pattern of showing that people who have their credit cards maxed out, that they then default on loans later on. The way to resolve this, if you like to charge up your credit cards and then pay them full at the end of the month so that you get airline miles or you get cash back on Discover, do like we do at my house. We pay the credit cards before the bill goes out whenever we're about to have any kind of mortgage or car credit score pulled. So in other words, if you know that every month your Discover card sends out a bill on the 23rd and that's their monthly cutoff, then on the 20th you go online and pay off your balance. And then when the bill comes out 3 days later, it's got a 0 balance and you've got a great credit score. Obviously, that's for people who pay in full every month. It's really hard to do that if you don't have the cash. The worst thing you can ever be is over the limit. When you go over the limit, that can lower your credit score significantly. So if you ever go over the credit score, over the credit limit, even temporarily, please make sure that you pay it back off mid-month so that it gets better again. All right, the length of the credit history is important because it shows your willingness to repay over time. Just keep in mind that even if you've had an account for 40 years, it's only going to show the 7 years of payment history, even though the time when it was originally opened will still show 20 or 30 years. Okay, we have a question in chat, and Annette's going to read it.
If there is a tax lien that you settled with the IRS for less than owed, how does that work on credit when it has been reported?
That's a really good question. And actually, paying a tax lien for less than what's owed is the only kind of settlement that doesn't matter. It doesn't show that you paid some kind of lower balance. It just shows that it's released. However, the tax lien doesn't disappear. it's still a part of your history for 10 years. So it's going to end up lowering the score less and less over time, but it's still going to be there until the 10 years have passed because it's a part of your record. All right, next we're going to look at new credit. Actually, when people open new accounts, it shows that they are in need of cash. And so whenever you're working with a buyer, be very, very cognitive of the time of year, because around Christmas time and around back to school, let's say late July and early August, and then all the way from, I guess now it's from Halloween until after New Year's that we call Christmas time now. But anytime you have a new buyer that you don't know or you haven't worked with in the past, be sure to tell them not to open any new accounts. Don't even get inquiries for credit cards. It's very easy to fall into the trap when you walk into the department store and the cute little kid with the clipboard says, would you like to open a new account? We'll give you 10% off your purchases today. The answer is no. Just say no. All right, in the interest of time, I think we've covered this well enough for the types of credit used. We've talked briefly about the public records inquiries, and okay, the other one is the number of mortgaged properties. So when you're looking at the number of mortgaged properties, that can also affect what somebody can borrow. So what I wanted to cover here is that you can see on the credit report how many mortgages a person has. It's not true that a person can only have 4 mortgaged properties. Freddie Mac will only allow 4 mortgaged properties. So if your lender says they only allow 4, then find another lender, because many lenders allow up to 10 because Fannie Mae allows up to 10. Beyond 10, it's going to be a portfolio loan, like a bank loan, so it probably will not be a low 30-year fixed-rate mortgage. And very hard to come by because most banks don't want to do lending on houses unless they can sell them into the secondary market to Fannie Mae or Freddie Mac. In the last few minutes that we have, we're going to talk about solutions to the credit problems. Number one of the solutions is in this disputing credit that we talked about earlier. When you dispute credit, there are 2 types of people or 2 types of accounts that people dispute. Those that are true and those that are false. A lot of people dispute accounts, and actually a lot of the credit repair companies use disputing as their main tool for trying to get things off of credit. And as a lender, obviously I don't think it's right, but at the same time I do understand why people do it. So I'm just going to say that lenders don't like it when true derogatory credit gets removed from a credit report, but there's nothing that lenders can do about it. On the other hand, if there's something that's false, it's very important to make sure that you get that dispute taken care of and keep fighting that battle until the day that you die, because there's no reason for a disputed account, something that's not yours, to remain on there. The other thing is, dispute anything that you can dispute. In other words, if they've got the wrong balance, if they've got the wrong account number, anything that's on there, the date that you opened it, can even be disputed. Now, on medical collections, this is a hot button right now because a lot of people find that they have a $50 medical collection and don't understand why it dropped their credit score 100 points. Remember back earlier I said that lenders and credit scores, credit reports, none of that will show how much you earn and what your assets are. So to one person, a $50 or $100 medical collection could be as big as a $50,000 one would be to Warren Buffett. And so the idea here is that they don't know whether it's big or not. It's a collection. Oftentimes, doctors' offices won't even try to collect. They'll send you a couple of bills and then send it to collections, and you don't even know about it until you go to buy a house. There is something called medical privacy. It's HIPAA, and it doesn't allow creditors or any medical provider to provide private information about your medical history. So I have found one of my top credit repair company people has been able to get every medical collection removed from a credit report simply because it's a violation of HIPAA. So that's an important subcategory to disputing things. You want to make sure that the first thing you do whenever anybody says that you owe them money for anything, ask for a copy for proof. And then if they show anything that has to do with medical, they have to remove it because it's a violation of HIPAA. Now, don't ask me how you do it because I'm not a credit repair guy, but I just know that that's the fact. Another solution is the history and passage of time. Every single month, if nothing changes on your credit report except that time goes by, then your credit score will rise. Assuming that you have some kind of good credit on there somewhere, then the bad credit will fade over time. Of course, after the end of 7 years, if it's not a public record, it'll drop off altogether, and then that's a happy day. But until you get there, when it gets past 2 years, then even collections and charge-offs will start to look less important over time. Inquiries and new credit, we talked briefly about that you don't want to open a whole lot of new accounts, but people often wonder how bad are inquiries going to look when you're getting a mortgage. If you haven't heard this already from some other source, keep in mind that you can have multiple mortgage credit inquiries within a 2-week period, and they all get counted as one inquiry. So it's not going to lower the credit score simply because of the inquiry. Now, that doesn't mean that if I pull a credit report 3 days after Annette pulled a credit report and we're both doing mortgage, it doesn't mean that my score that I find won't be lower because any other thing could have been reported during those 3 days. It's just the inquiry aspect that won't count against you during those 14 days. And by the way, the same thing goes with car loans. If you're shopping for a car and you go to multiple dealers and they pull your credit 3 times at each dealer, that won't lower your score as long as it's within a 2-week period. So always keep that in mind and tell your customers that they can shop for a mortgage and it's not going to hurt their score as long as it's within a 2-week period. The next question would be, how long does it hurt your score? And the simple answer is nobody really knows. It depends on how many inquiries you have. But I can tell you if all it is an extra mortgage inquiry, it probably isn't going to hurt anymore after 60 or 90 days. I've seen that it doesn't drop the score more than about 5 to 10 points initially, and then you get back those 5 to 10 points in about 90 days. Then we've got types of credit. One of the solutions is that you don't have enough types of credit, and so you may have only 2 lines of revolving credit. So what I tell people is go to your credit union or go to one of the big banks and see if you can get an auto loan against your car. Doesn't matter that your car is worth only $5,000. You can get a $1,200 12-month car loan, pay it off over 12 monthly installments, and at the end of 12 months, you've got 12 months history of a different type of credit. So I always recommend that you don't just get credit cards. Go ahead and see if you can get a car loan, even if you don't need the money. Take the money you borrowed from the car and use it to pay the car loan right back again. Interest rates are so low, you're not going to pay much for it. The next bullet you see are the secured credit cards bullet. Secured credit cards are a way for people who don't have established credit or they don't have a good credit history to reestablish credit. And what you're doing with a secured credit card is you're giving the creditor your own money and borrowing it back. And it sounds silly, but it does actually establish a habit of paying people on time. When people give somebody their $500, then they go out and use the Visa card, and they get a bill, and then they mail that payment in on time. So even though it sounds like it's not really all that helpful, it's better than having no history at all. And I will tell you this, I have seen people who don't have a willingness to repay to be late on a secured card too. They just don't establish any kind of record keeping and don't ever get into the habit of paying things on time. And again, that would be one of my kids. So anyway, the secured cards are a really good way to start building credit, especially if you've had some kind of an event in the past where nobody will give you any credit at all. That's the way that you can start. Now we've talked about collections and charge-offs, and we're about out of time. So if we have any further questions before we go, we have about a minute or two that we can answer any final questions. Let's see, what percentage of the credit score, bounced checks, and late payments to utilities or service companies affect the credit? The simple answer is not at all. Unless a creditor is reporting to the credit bureaus, then being late on all of those things won't make any difference whatsoever. The only problem you run into is when you have a collection account for any of those. So if your creditor, or let's just say if your bank sees a bounced check and you never pay it back, they can eventually go ahead and report that as a charge-off or send it to collections, and then it's going to show up on the credit report. Same thing goes for utilities. Most utilities don't show up. The only exception might be occasionally that you have an inquiry from a mobile phone provider, but that's just an inquiry. They never show up as credit. If the utility does send it to collections, then the collection account will show up on your credit report, and then you're back to the same thing as you would have with any other collection. All right, looks like we don't have any more questions, so
Okay,
thank you so very much.